So hope everyone's had a good week and it's not coming through too cranky. I was having a chat about what to discuss tonight and everything else, because we've gone through back testing, we've gone through setups with swing failure. They're all dodgy, Graham. Now I have been touch wood. I went to the emergency department here and you wouldn't believe it, they don't do x-rays after hours, so I ended up having to go to work and x-ray myself. That was interesting. So we've done back testing, we've done the scalping, and in the back testing we incorporated swing failure, and we've done a pre-trade routine. So I thought with the way the markets have been and now we're starting to swing back up, we might just go through some very basic money management strategies, because I've been hearing some great stories from people and a wonderful response to how they've been going, and others that are really, really struggling. And Brent once posted a little Excel spreadsheet, I think it was DDSM or something similar, and you could place your trade in it with your set risk and set profit, and you could see how your trade would develop if it let it run. So this is a takeoff from that, even though I won't be showing that at all. So it's just basic money management, and I've got to thank JJ or Jeff for a lot of this, because part of it comes from an article he put up, which I then went back and found and had a good read of and everything else, which I've mentioned at the end. So here we go. Okay. Now, we've all heard people pulling in some ridiculous amount of money in a day or in a trading session, and I have a PDF where some guy's trying to tell us about how you can double your account every day. So we're not talking about a 1% gain or a 2% gain. This guy's talking literally about doubling your account per day, literally 100% return or 100 units if you're using a 1 unit risk. Now, and it is possible, and I'll admit that, and reading through his strategy and what he's basically espousing, but in all honesty, I don't think it's practical, and it's not something that you're going to be trading for the next 20 years. A lot of these people that make these huge accounts, huge returns on their accounts, generally find that they're either exposed their account to an excessive amount of risk, there might have been some luck involved, or might have had a profitable windfall. They might have taken a position and then all of a sudden, the Swiss bank intervenes and it shoots 500 pips straight up, or the Japanese bank intervenes, or something's happened and they've let it run. Eventually, looking at this other strategy, when you do take a loss, the loss is of such a magnitude, it's of such an amount that it'll devastate your account within a couple of trades. You don't get many shots at this, you've only got a couple of shots in the gun. And emotionally that can be absolutely debilitating, can actually destroy you, and it'll also destroy your account. So there's a number of key money management techniques that I use, and these are all based on sound money management techniques that we read about and what we see the professionals doing, which can make a big difference to our bottom line. So the basic money management techniques are fairly straightforward, and I've listed them, some there in point form. First and foremost, always use a stop. Now, I have been guilty and still do use mental stops sometimes when I'm scalping. I'm very proud of myself. I've come a long way and actually got rigid stops now in place. And in my case, that meant that I went and bought some EAs and some other little tools that put them in automatically, so I'm not second guessing myself. The second point is to use a proven and tested methodology for calculating your stops rather than just an arbitrary figure. You're not going to enter a trade and just take 20 pips stop loss if you're halfway through a trend and there's a chance that it can retrace back to a 50% or a 64% fib ratio. So you want to use a system and a reason for putting the stop in place, whether it was a previous high plus a certain amount or whatnot. that depends on your strategy. And that goes along with the next one, which is to use a proven and tested trading system. I mean, there's a lot of wonderful systems out there, some great people out there, whether it's Day Trading Forex Live or Steve Mora, or James got his course coming up. John Shealy's been fantastic and has re-offered his course and his systems again. So guys, if you're looking at something, definitely look at that one. There's a lot of things out there where you can learn to trade and get a proven system that we can then just start to apply. One of the most important rules is to be aware of your trade side, taking into consideration the 2% rule. Now, please take the 2% as an arbitrary figure. This is what most textbooks talk about. I don't trade 2%. I actually trade 1%. I've got a friend of mine that trades more, and I've got friends that trade less. You've got to find a limit that's good for you. Whatever that limit is, and for the purposes of the discussion tonight, we're going to call it the 2% rule. You never want to exceed 2% of your trading account size in any given trade. Whether it's a scalp or a swing or a long-term trade, you must stay within your defined risk per trade. Overall though, you've also got to have a total risk to your account that you're willing to expose all day. And I actually use 6%. So, at any one day, no matter how many trades I've got on, my total risk will never be 6%. I'm never going to go back into the roof to fix a heater that's gone and a pilot light that's gone out to come back and see my account 9% in the red. That's not going to happen. It's happened once and it won't happen again. So there's an extra T in there. So you want to use what we call an overall risk. Now, the 6% overall risk means that if I'm risking 2% a trade, my maximum trades per day is 3. 3 times 2 equals 6. If I'm risking 1% per trade, I can be in 6 concurrent trades. 6 times 1 is 6. Or whatever your risk percentage, if you want to scalp and you need to put more positions on, you might risk 0.5%. And at 0.5%, you can have 12 concurrent scalping trades going at once, but you're still within the total defined and acceptable risk parameter to your trading account. The next point is always trade with risk capital. And it follows on with the next several points, is you're basically going to be trading money that you can afford to lose. And guys, we can make a lot of money, and people have made a lot of money trading Forex. There's a lot out there, and we can all take a small bite of that 4 trillion market. But with the leverage involved, we can be hurt just as bad and have just as many problems. So do be careful for me. So my advice to people is only risk money that you can afford to risk. And in line with that is don't ever borrow money to go trade on Forex. I know people that have. I don't think it's wise, and that's just me personally. Unless you're really experienced and really doing well, and even then I'd be really, really cautious. I read a story back in one of the old Skype groups where a gentleman had taken his kids' college fund to trade and blown it. To me, not only has he just blown money that he's put aside, he's blown his kids' future as far as I'm concerned. So don't ever borrow money. I don't care where or how or whatnot, and that's just my take on it. Personally as well, my trading account is never greater than 10% of my total net worth. So what that means is I've been very lucky and fortunate. I've got a good friend, and we sat down several years ago, and I've sat down and I've got a weekly budget that my beautiful wife and I try to stick to. Not always successfully, but we do try. I'm aware of my overall position financially. I know exactly where I am in terms of my assets and loans, what's required to service them or not. And then knowing that, good or bad, will liberate you, and then you know how much you can actually then risk in the market. So my accounts will never total more than 10%. Now, if you feel comfortable trading and don't mind putting a greater percentage size on, do so. But just remember that the markets are liquid, and we're beholden to the market makers and to our broker. If they go belly up, and there are shonky ones that have their trust on in some weird and wonderful strange places, there's a chance you could lose a great deal of money. So my priority is to always make sure Jenny and the kids are secure and cash flow positive. The last point is to develop a trader's mindset. And we'll get into the trader's mindset. But the trader's mindset you basically develop with experience. You read books, you spend time in front of the screen, both back testing and live, and get to understand how your system works and start to think like a professional trader. Okay? You don't go in there, for example, to play baseball, expecting to, have the mindset of a boxer or a race car driver. There's a mindset that you need for trading that we need to have to be successful in what we do. And the trading mindset is actually very, very unique because this is a profession where we can be right 50% of the time and we can be wrong 50% of the time. So except for meteorology, they also have that same sort of mindset, but we won't discuss meteorologists. Now, I like reading books, and I've got a slight collection. And one of my favourites is Safe Strategies for Financial Freedom by Ben Kathopoulis, and a few of the boys way back in the old YTR days got me onto reading this. And that's a great book. It talks about your money management, your psych and everything else. So I enjoy reading books. I get a lot out of it. Along with that is another book by Ben Kathopoulis, which is Super Trader, which will flash on your screens in a sec, hopefully. And then one of the classics of trading, which is really, really important in developing our trader's mindset, is Trading in the Zone. We've all heard about it. I do highly recommend it. I thoroughly enjoyed the book, and I've read it a few times. And there's a squillion more out there. There's plenty of books all over the place. Another one that I actually like is one called Trading to Win, and that's by a guy called Ari Kiev. So have a read. They're interesting books, and hopefully what they'll do is just let you start thinking about why we're doing things and how we're doing it. And nearly all the concepts you guys will see that we discussed tonight are basically from these books to a greater or lesser degree. So we'll get started right into it. So the first slide we're going to look at, guys, is calculating proper trade size. So your trade size will directly affect the return you get per trade and the inherent risk per trade. Fairly straight common sense. The more you're going to risk per trade, the greater the profit potential that we have. But the greater we're risking, the less losses we can take before we blow our account. So risk and reward is a bit of a seesaw act in trying to get a balance between putting enough risk on to justify a trade to make a decent return for the risk we're taking, but not so much that we actually blow in our account. So for example, there's a couple of statistics I've put up next. If we risk 2% and we take a 2% loss, so our account has dropped from 100% down to 98%, we actually need to make 2.04% to get back to break even. So with every losing trade we have, we need to actually make more in the subsequent trade to make it back. For example, if you took a 10% loss, you need an 11.1% win or streak of wins to actually break even. And the classic is if you lose half your account, you actually have to double your remaining amount, make a 100% return to get back and recoup your losses. And this is the problem with risk reward, because the more we risk and the more we lose, the greater we have to work to make it up. We actually are working behind it mathematically. It's a negative sliding type scale. So there are strategies which espouse really high leverage. And me personally, this is not something I would recommend to anyone. And as always, I'd recommend caution and just a little common sense. For example, the double in a day forex trading technique is an interesting technique. Doesn't really say much, but except the guy wants you to develop a system and then put the max amount of lot size you have on and keep adding to it. Well, there are people that can make 100% in a day, and God bless them. I hope they do. This is not something that I would try, because putting that amount of lot size on, you run a real chance of actually blowing your account. I'm here to trade. I'm not here to gamble. If I want to gamble, I can take my money, go to roulette, play red and black, which is almost a 50-50% win-loss ratio, and throw all my equity into that. And it'd be just as profitable as doubling in a day. Long term, it's not viable. And that's why casinos have a system. That little green zero gives them a system or an edge, which long term means they always win, especially against guys that try to double their account on a single run. So do be aware of that, thoughts. What we tend to find is newbie traders who tend to focus on the trade outcome and tend to neglect the inherent risks. I remember Todd discussing scalping and him mentioning that he had a fairly large stop loss, but he had a 98+% strike rate, which was phenomenal. And that was only possible because Todd used such a tiny position size that the impact on his account was negligible. And the system he used, he had it down to a T that he knew exactly what he was going on. So that's the difference between a professional trader and a newbie. A lot of newbies tend to think of 90% success rate. So what they do is, rather than taking a mini lot or a micro lot on a trade, they ramp it up. They'll put a full lot, risk 2%, 10%, 20% off that. I've got a good friend of mine that's blowing 4 accounts because if he's going to be successful trading a $500 account and putting a mini lot on, why not put a full lot on and see if he can double it? Well, usually the market turns against him, he gets a margin call, and he's blown another account. So what professional traders actually do is they'll focus on the risk, and they'll take trades based on their proven system within their risk parameters. And this is why risk, first and foremost, should be the first thing we consider in our risk to reward ratios. Thus, in total, and I'm quoting out one of the books here, thus the psychology behind trade size begins when you believe and acknowledge that each trade's outcome is unknown that's my typical spelling mistake, at the time you enter the trade. Believing this makes you ask, how much can I afford to lose? So the psychology behind trade size begins when you believe and acknowledge that each trade's outcome is unknown. And at the time you enter a trade, we have to ask, how much can I afford to lose on this trade? And you should literally sit there and think about it, because there is a very real, and it will happen, chance that we will lose on a trade. Some of us unfortunately have already lost, and lost significantly. And can you afford to keep losing at those sort of levels? G'day Brent, you're not late, buddy. There's a link up top, Brent. You can download the PDF of all these slides if you like, champ, so jump on. So how much can I afford to lose is a really important question. So it's quite funny, on a $100,000 account I'll turn around and make $200 or $300, and initially your friends and my wife even would scoff and laugh and think, what's the point? Well, the point is, over a year that $200 or $300 a day, 0.5% can still be a 25, 40, 50, 60% gain on your account. And looking at what the banks are paying us, that's still a significant return. I can't go and buy real estate and get those sort of returns without the associated hassles and headaches and trying to really be nasty and screw someone down. So you've got to start off with thinking of how much you can afford to lose and how much you're willing to risk losing, to actually then take a step forward and start making a profitable trade. So based on those discussions, my wife gave me these little pictures to put up for everyone. So a quiet man is a thinking man, and a quiet woman is hatching a plan. And we need to have a bit of both of those when we're actually trading as part of our trade plan. We have to sit back and think, how much can we afford to lose and what's going on? And once we're aware of that, we should put the women's cap on and start thinking, how are we actually going to implement that, knowing that risk. The other one was just purely sexist, and I thought it was absolutely hilarious, so I just put it in there. So I'll leave you guys to read that one. Now, when we actually look at most traders, every professional trader I've ever spoken to talks about their win ratios when I ask them. And it's a question I always ask, what's the probability of winning? Because we are dealing with probabilities. And this is, again, statistics as much as I didn't like it at school. And the majority will have a 60 to 80% win-loss ratio. They'll have good days and bad days, and you'll find the majority tends to be towards the 60% line as opposed to the 80% line. There are systems and different sort of strategies in place that can give you a much higher, but they tend to use some complicated mathematics and whatnot to actually do that. So if we assume that we're going to win 60 to 80% of the time, the converse of that is, guys, that we're actually losing 20 to 40% of the time. So in 10 trades, we're going to lose 2 to 4 of those trades, just above half. So if we're losing 40% of the time, our risk control becomes really, really important. So, most newbies, and I've got a good friend which I won't say his name, he could take 5 losses in a row and completely blow an account and, had a, he's lose $500, $2,000. I think in total he lost 10 grand before he threw his hands up and said that's enough. Whereas I've got other friends who can have a terrible week and have, 4, 5, 6 losers in a row, but because of correct money management, have a couple of wins and actually come back out in front. And this is where our risk and reward becomes very, very important. So whereas a newbie will take these sort of losses and actually blow an account, a professional trader has taken the likelihood of such a bad occurrence happening and will actually trade accordingly, and it will actually be incorporated into his actual trade management plan. And our plans are really, really important because they'll actually define us. And our plans are an offshoot of our trader's mindset. So when we discuss trader's mindset, we must realize just as important as our risk management is our confidence in our trading system. And this is all part of our trader's mindset. Even the best system will have periods of drawdown, which is multiple losses in a row, and it happens. We'll have crappy weeks sometimes, and whether the market's just been that way or we've been off colour or we've run into a wall at squash or something rather than doped up on drugs. So you've got to realise that these things happen, but you've got to have that confidence in the plan. And the confidence is basically gained by our screen time. You have to spend time at the screen. I get these emails from all of these Forex groups and everything else saying, you only need to spend 20 minutes a day and you can make a squillion dollars a year. Well, possibly, but those guys that can spend 20 minutes a day and do that sort of stuff have years of experience behind them, and they are very, very few and far between. So, even the Grandmaster and Geo and whatnot who do these long-term trades still give up their Sundays to start preparing their charts and drawing their battle lines and treating this as a business and seeing how they're going to tackle the market this week. They've got to do that. He does his preparation like we all do, and you have to spend that time. I used to scalp, and I still enjoy scalping, but for me to be profitable as a scalper, I had to sit here. Even though I've changed my methodology and I'm looking more at the swing failure stuff, I still scalp in between, but I still spend a good 30 minutes before I pull the trigger on my first trade, preparing for the day and seeing what's actually happened in the market and drawing my boxes in place and getting an idea of what's happening in the market. And we need that. We need our screen time. And then I'll still backtest, and I still have my soul searching Sundays, which lets me start figuring out what's been going on. So the trader's mindset takes time and experience, but the following traits should be cultivated. These are the things that we should really consider to have and focus on trying to build within ourselves so we can be the best we can be as traders. One is to have a sense of calm when trading. I personally would find it really difficult to have 20 cans of Diet Coke, no pun intended, and try to trade and scalp. I'd be on such a high with all the caffeine and stuff, I wouldn't be stable. So you have to be calm when trading, because if you're emotionally jagged, so if you're anxious or angry or upset, you've got pressure from your boss, or you put all your superannuation money into a trade and it looks like going under, you're not going to make clear, coherent thought. So you don't want to be out of kilter when you're trading. Next thing I said, is you want to be able to focus on the present reality and not on how we would like the reality to be. Now, I'd love to take a trade now on euro and watch it go up 400 pips. Well, that's what I'd like to see, and I'd like to be in a long position. But the real reality is that even though we might be in an upswing, there's a lot of fundamental issues going on and everything else, and you need to trade the price action as it is on the chart. Don't extrapolate from the price action, or don't push or think you can move the market with your mind, because it won't work. So we have to learn to disregard which way the market breaks or moves. We just have to see the price action as it occurs and trade accordingly to what we see. We also, and this is going to sound strange, we also have to trade from a point of view that the money isn't the point. Fundamentally, guys, the game is trading and it's all about the money. So I'm not saying that we should just neglect that, but if you start talking about dollar amounts and whatnot in your head, it starts to become a really difficult scenario, because you start to get that emotion starting to play on you. I can talk to someone and they lost $10 on a trade because they're trading micros and took a 100 pip stop. Whereas I've talked to other traders who trade for a living, and they can turn around and take a $40,000 loss and shrug it off, because that's just part of their risk management plan, and that's what they expected. It's part of their risk, and that might be that 1% risk or that 2% risk. So the goal isn't trading about the money. What we're trying to do is to trade this successfully and to keep our win-loss ratios at such a rate that the money will start to actually turn and kick back over. We should always be looking to improve our skills, and I've harped on about it. I really enjoy backtesting. I'll go back and I'll backtest a week and see where I could have done something, and just to get a feel for the market. In line with that as well, in terms of improving our skills, we should always be open-minded. Keep our opinions to a minimum, and I know that's a bit hypocritical coming from me trying to lecture everyone on a Friday, but you need to keep open-minded. I realise that the way I scalped, as wonderful as some of the results were and are, it's not a viable option for me to do for the next 20 years. I don't want to be stuck to a computer. So when I saw the possibility that I could incorporate another technique on top of it, it changed the way I traded to a degree. Still scalp, and swing failure now dominates my trading, and my scalping is in line with that. So that's how we worked. In line with the sense of calm, we don't want to trade when we're angry, and that's pretty straightforward, guys. And my wife and kids usually think it's hilarious, because I do enjoy trading. If I'm going to sit here for 4 or 5 hours a day in front of my computer screen, or 8 hours or 25 hours like we did once because I was stupid, I need to get a kick out of it. Now, I'm not saying get a kick out of the gambling or a kick out of risking money or anything along those lines. I enjoy the process. I enjoy putting my skills up against the market and against the market makers and seeing if I can walk away with a profit. So I tend to, which probably sounds a bit silly, treat it more like a game. But what that does is it alleviates and it takes the pressure off me and almost that responsibility to a degree of worrying about losing cash. I've got cash aside that I set and I trade, and then like a score, cash is just the money is just a means of keeping a score of who's winning. If I'm starting to lose, then I know that I need to bow down and step away. So in line with that, trading 1 or 2 chosen approaches. Don't mix and match. There's no point trying to scalp, do a swing failure, and at the same time incorporate fibs and longer term trades and have a black box system. What you're going to do is basically confuse yourself and not know where you are in the market. A nice little chat with a lovely lady who's had a wonderful week, and she's just focusing on one pair and her one strategy. And because she can devote her time subconsciously, what she's doing is her mind's working at its maximum capability to do the best that she can do on that. We're not trying to mix and match and everything else. At the same time, you don't want to feel like you need to control or conquer the market, because as soon as you start feeling that you need to control or conquer it, market will turn around and give you a quick swift kick in the backside. At the same time, you don't want to feel victimized by the markets. The markets will move. You know, this is a business. There's big companies out there and big enterprises that make their living off this. So we've got to realize that there's a lot of big sharks out there. And what we need to do is learn to swim with the sharks, not against them, so we don't turn out to be a little bit of a meal. No? And at the end of the day, we need to be responsible for what we do in our trading. Right? So if you're going to sit there and have a stop of 20 pips and not like the price action and move your stop out to 40 pips and you take double the loss, well then that's your fault. You broke your trade rules. Now the 2% risk rule, guys. Is everyone with me so far? Is there any questions or anything you want me to reiterate? I'll give you a minute and I'll have a sip of Diet Coke. All right then, we'll keep going. The 2% risk rule. Thanks, Brent. The 2% risk rule is designed to keep us out of trouble. Some traders actually risk less, and personally my maximum risk is 1%. I just have a psychological barrier of putting on, no matter whether my account's $100 or $100,000, I just have a psychological barrier with 2%, and that's just me. And realizing that, I just stick to 1%, and I love the way Phil trades. Phil doesn't talk about money or percentage of one, he talks about a unit. And the unit is, if you don't mind me discussing it, Phil, a unit is whatever risk percentage you want. So assuming 2% is our risk, 1 unit of risk is 2%. So when he goes onto a trade, he knows exactly how many units he's gone against him and how many units he's moved forward. And he can standardize that across all of his trades. So it's actually a wonderful concept. The way we calculate our risk, or R, is basically dependent on our account size. So we take our account size and we multiply by that percentage. So assuming a 2% risk on a $50,000 account, it's 50,000 times 2 divided by 100, or $1,000 per trade is what we'd be risking there. Once you determine your risk amount, we can then determine the lot size depending on the number of pips we are taking as a risk. And this is where using Phil's unit of risk as a matter of point, because if you have a trade position and it means that when you do your analysis you need to have a 40 pip stop loss, you can still trade your risk, your 2% or 1% whatnot on that 40 pips. If the next setup gives you a 20 pip stop, well then you'd be still risking 1% or 2% or whatever your risk or unit risk is on those 20 pips. And this is where there's some people say that if you've got a smaller target, you should risk less or risk more. That again comes up to you. But what Phil has done, which is quite smart, is he's standardized his risk. So he knows exactly what he's doing per trade. And that's something that I would really urge everyone to do. So in line with that risk is the little point that I've put down at the bottom, because I don't mind scaling in to a position even as I scale out of it. If I'm in a trade and I've effectively moved my stop up, so I've got a swing failure, for example, my risk was 1 unit at minus 20 pips, and my stop has moved to break even, and I've blocked in some profits, and I see the potential to add to a trade, I will still add to that trade and re-increase my risk. And what that'll do for me is compound my winning position. So I don't have any problem whatsoever adding to a winning position if it fits my risk profile. And you'll see some guys do that successfully, some guys don't like doing that, and that's something that you guys need to espouse or need to write up in your trade plan. And that's an individual thing. The next slide comes from a discussion I had with someone a while back. This was the gentleman that unfortunately used his daughter's account to fund his trading, and it went belly up. Many traders either borrow money or use money they cannot afford to lose. This either sets you up for failure as you are subject to the market's manipulation, which in turn exploits our emotional need for a positive outcome. If you're trading and using your rent money, then we've got a real issue, guys, because what you'll basically start doing is start bending your rules and not be able to take a loss properly. Now, unless you've got a lot stronger will than I have, and most people have, what you'll start to do is you'll need it to win. When you start to need it, then we've got real problems. So, in my opinion, never borrow or use money that you can't afford to lose. If you are nervous of taking a loss, you'll experience more anxiety, possibly to the point where you may start to manipulate your trading rules and thus fail to exit a trade. And it takes discipline and courage to take a loss when your stock tells you to. So I talk about a gut feel. So if I have a position on and I've taken a trade and I start to feel queasy in my stomach, either for whatever else, I know that I've risked too much on that trade or something's not quite right according to my trade rules. And if I get that feeling, I'll stop and I'll take a loss. -2, -5 pips, -10 pips, I don't care. I'm not going to risk my account any more than I have to. So don't borrow money to trade. If you have issues or have problems, or you want to trade, but we don't have a size that suits, start off with a paper trading account, a demo account, hone your skills and get better to it, save up slowly, and then open a micro account and gradually build your account up. The analogy I give to people is Rome wasn't built in a day. We're not going to become the world's greatest traders in a day. It's an ongoing process. This is something that we will learn from and have to continue to learn from. So, just like the Vatican took a while, my accounts have taken a while, and I've just closed all my personal accounts to do some renovation work and whatnot at the clinic and at the office. So I'm going to have to start from scratch again, and I think it'll be a great challenge and something I look forward to. Now, along with the trader's mindset, we discuss scaling in, which is something I do. A lot of people also scale out. Now, I do this as well, and just for your reference, that's my godbrother George, and typical barramundies we get back home in Darwin, so he knows his fish. Scaling out can be incorporated into your money management plan as a component of risk control. The idea is to reduce our stress by quickly locking in a profit and basically ending up with a free trade. Now, you don't want the axe hanging over your neck whilst you're trading, and as soon as you can slip the noose or get away from it, then you tend to trade from a position of no pressure, and it's quite amazing what happens. The initial trade size should still follow our 2% rule if that's what we're risking. So what I tend to do is I'll trade, I'll exit 60% of my trade size when I reach a target with a minimum risk reward of 1:1. So if I'm risking, say, for example, 1 unit of risk at 20 pips, I will take off 60% when I'm at 30 plus 33 pips. So 33 pips at 60% gives me 1 unit return. So I've actually taken all my money out and made a 1-to-1 return, but I've still got 40% of my position actually trailing behind and hopefully getting more and more profits for me. So, and I've got an example at the end where I actually did that this week and wanted to show you everyone. So the remaining position is scaled out as price moves to further targets, with the final position being closed when price action signals a reversal in the trend. And again, this comes down to the system you trade and what you've got in your rules and in your trading plan. And this is something that I've started trying to incorporate. I've always done it to a small degree when I've scalped, but with the swing failures, and especially if I can get into a level 1 move and try to ride it down, like Brent did a great trade earlier in the week, I believe it was Brent, wasn't it? Something like that can really compound your position size. So I've got an example for you on the next slide. Start of the month. Thank you, Brent. That was a nice trade. So I had an EU short a couple of days ago. Don't know why there's a 6 in there, but I'll have to spell check, doesn't work too well. I took an entry at 127.667. My stop was minus 25 pips and my risk was 1%. So my unit at minus 25 pips was 1%. So that's 1 unit. I took a stop to break even at plus 32 and I basically trailed by 32 pips. My first target was at 50 pips where I took 60% of my position off. My second target was at 70 pips where I took a further 20% off of this position, and my third target I just had a dead stop at 100 pips and I closed it outright. So hopefully it'll show you the setup here. Now I do apologise if it looks a bit small. This was a swing failure on the EU that I took. I had already calculated that we were in level 3 congestion. I'd already taken a drop out. We had those big wicks up to the top here. Just through there. Excuse me guys, I'll pull it in. So we had nice big wicks to the top. Can you see that? And we had a level 1 push. And it's gone through, and what we did at coming out of Asia, we had a retest of the highs multiple times, and big green candle came in, and I took it as it broke underneath the lows of those two candles, and my stop was 25 pips, which put me back into the congestion above, and then I started to ride it down as far as I could. So my first take profit at 50, second one at 70, last one at 100. And I had that all programmed in. So this one actually worked quite well. Oops. So if we go through the calculations, you'll understand why I liked it. Everyone with me so far with that trade? Not so much important why I took it or whatnot. The example is basically to show you how I'm using it as my trade and risk management. So we took an EU short at $27.67, say, 25 pip stop at 1% risk for total risk of R units. So went to stop at break even at plus 32 and we trailed by 32 pips. So as soon as it reached 32, I'm actually pretty much in a free trade. So my worst case scenario was 0. It hit target 1 and at plus 50 pips I automatically, because I used one of the few times I've used is it? That's how long I've used it. MyFix, that's the one. So at, excuse me, so at plus 50 I took off 6% using MyFX. So 50 pips times 60%, I've got, that turns out to be 30, which is a 1.2 risk reward return. So if I'd risked $1,000, I basically closed out my first position at $1,200. So I'm already in front, and the remaining 40% is still trailing by 32 pips. So at target 2, I took another 20% off. So plus 70 pips times 20% gave me a further half a unit of return, just over. And then when my final position hit 100 pips, I closed the rest of it for another 0.8 units. So my one trade, where I risked 1 unit, ended up returning 2.5 units to me, which is nice. I could have stopped the whole thing off at plus 50 maybe and tried to ride it further. I'm not too sure. You've got to play with your statistics and see how much you can make out of it. But one of our traders here tonight has had a wonderful trade where he netted over 3.5 units on one trade, and that's great. And I think you've heard Geo have a risk reward of 10 to 1 and 20 to 1, where he's carried some of these longer trades. But mine was based on the fact that I'm looking at the market to swing and bend. with the swing failures, I was really, really happy with that trade. So a nice trade overall. And that's how I use the concept of risk. So in conclusion, guys, you've got to acknowledge the fact that there's risk in trading the markets. If you're going to blindly enter and trade, then you might as well just give your money to the first bum you meet on the street, because it'll be put to better use rather than helping some broker buy another Ferrari or another drug habit. So conversely, we don't want to trade blindly, but we don't want to be too scared of trading either. Because if we're too scared, or if we come from a negative point of view, like you're anxious or angry or whatever else, or depressed, it can be just as bad as trading when you're overconfident and cocky. So we've got to balance both sides of our psyche to make sure we approach the market our full awareness. And part of that is paying close attention to our risk control. So if you can trade from a calm position and be aware of what's going on, isn't it? What you'll create is a feeling of abundance. And by that, what I mean is you can trade without any emotional stress, without that weight of the world on your shoulders, and you'll know that your account will kick over at a rate that suits you and can actually, really, really help. So think about it all. Think about how you've incorporated into your trading plan. And for those of you that don't have a trading plan, do one. Stop trading. Stop trying to throw pips at the market and trying to grab things or follow anyone's advice on Skype or anything else, and sit back and think, what do I like to trade, or what should I trade, or how should I trade, and actually come up with a trading plan. So one of the suggested readings that I have here for everyone, which is where most of this all comes from, and I've almost quoted it verbatim, is Bennett McDowell's book, Survival Guide for Traders. So, develop a trading plan, find a system you're comfortable with, and if you're not too sure, copy someone. Copy Geo, or copy Day Trading Forex Live, or copy James, or copy anyone else, but still put it down on paper how you're going to trade it. Give it a good solid month, 2 months even better, and if you're comfortable with it, you can continue. If you don't feel comfortable with it, then start changing things. Give it a solid chance. And hopefully what that'll do for you is you'll get to understand what you're doing, and it'll give you that trader's mindset where you're comfortable with what you do, and then you can take that and start turning that into real money in the market. So I hope that all made sense to everyone. So I'm going to open the floor up if anyone's got any questions, or if there's anything you want me to go back to, or anything along those lines. Or if you want me to show you more fishing pictures. Jane, did I get that book in Vic? Oh, how did I get that book? I love Amazon, and I've got a bucket load of books. I'll see if I've got it, Jane, and I'll send it to you if you like. If I've got it as a PDF, I'll find it for you and I'll send it to you. But I've got a myriad of other ones. Just go to Amazon, it'll be there for sure. A lot of my books now are on my ebook reader. So I've got Kindle on the back on my Mac, I've got Kindle on my phone, I've got Kindle on the iPad, and then I've got the iBook store, and I just download books, and even the PDFs I've stored on my phone. So if I go to an appointment or somewhere and I'm having to wait, I'll just pull out a book and have a read and make notes and extrapolate from that. To me, reading is one of the simple pleasures in life. If I'm going to read, I'll do something I enjoy. Yeah, it's a good thing, isn't it, Jane? Great little devices. But there's been a lot of books on there's been a lot of great books posted by people that have been sharing some of these ebooks around in the Skype group. So, make sure you read them. Don't go reading a book though, guys, and getting an idea and thinking it's going to revolutionize the way you trade, and you start tinkering with your trading plan. I've read hundreds of books, but my trading plan is still pretty much the way it's always been. It doesn't change very much or very quickly. But it does make you think. When you start to think, you start to get that trader's mindset where you start to be more aware of what's going on in the market and how things are going. No, don't keep tinkering with something because you'll never get a feel for it. Any other questions, guys? And I do apologise for having kept you waiting so long. There's some technical issues getting the screen share happening, which is a pain in the backside. But exactly right, Brent, which is why when I take my scaling out, I scale at such a position that my win to loss ratio, my risk reward is still a minimum of 1-to-1. Because if you start scaling out, let's say at half a unit, and you've risked a full unit, and then your second and third targets don't hit, well, your win to loss is actually a negative. It's a 1-to-2 against you, which is not a profitable long-term strategy. You'll burn your account out. You might have lots of little wins because you're hitting your first target, but then on a -1-to-2, one loss blows out 2 positive trades. So very good point, Chan. If you guys do want to scale out, you want to be fairly confident that the market's going to move in your favour. What I tend to do, having realised that, is I will scale out, for example, on a 25 pip stop. I'll scale out when I reach a certain percentage and it covers my risk reward. I want it to be at least 1-to-1. So on the example I showed everyone, here you go. When I took my first stop at 50 pips, my risk reward was risking 1 unit and I returned 1.2 units. And what that did for me is it gave me a free trade, and the money that I had initially risked, I had it there. So even if there was a loss, I know that on my next trade I'll make it straight back. Now, in all honesty, guys, looking at that trade, if I'd closed my entire position at 50 pips, I would have gotten 2 units, not had to worry and let the trade run for an extra half day. And this is something that I've got to look at in my trading plan. Is it worth my while having 3 targets, or should I stick to 2 targets, say, plus 50 and the remainder at plus 70? Because that plus 70, if I close the rest of my 40%, that would give me 28 pips. That's 1.12 units. On my first one, there's 2.32 units, which is almost the same. So for a negligible 0.3 of a unit, I could have closed the entire lot out at plus 70. And that's something that I've got to slowly work on. And the way I work on it, you'll hit target 3 release. That's exactly right, Chan, and which is why I still have a trailing stop, because I always do want to walk away with a greater risk reward. And the only way I'll know whether that'll work is, I'm pretty meticulous about my trade diary and seeing how I've been progressing. I'll actually sit there and I'll look at my win losses, and it was Tim Wheatley, I believe, who coined the term soul searching Sundays at one of our little Melbourne group meetings. And it's great because I'll sit there on a Sunday and go through my trades and figure out, all right, this is what happened. Why did I get out this position? What made me close my trade here? Can I improve that? What can I do better? Was I angry? Was I too jubilant? Was I getting too emotionally excited like I sometimes do? Was I not paying enough attention? Or was I paying too much attention? Was I fiddling with it rather than letting it run according exactly to my trade rules? So a lot of times, to stop myself from fiddling and breaking that, I will actually stop and get away from the computers for 15 minutes and go cover my wife or play with kids, or I've secretly been playing Worms, that old game from the 80s and 90s where you've got to blow each other up. And that's just my way of getting away. Still paying my full attention to the market, don't get me wrong, I don't want to be flippant about it, because no one should be flippant when they're risking money on the market. But it stops me from twiddling my fingers and getting trigger happy or itchy trying to manipulate it. And that's my biggest fault personally, is I'm a bit of a control freak. And realising that I need to do things to get away from that. But very good point, Brent and Jane. You are right, Chan. And the way I try to mitigate it is making sure when I do close out a position that I'm actually closing out with a risk reward of 1-to-1. Any other question, guys? Agreed, that long trade I had was most taken at plus 50, last at 297 pips after 4 days, yet the average ended up just 78. And that's a fascinating point, Brent, because if you look at it, buddy, and I know the way and how successful you can be when you trade, you do really, really well, Brent. It's actually fantastic to listen to in the Skype rooms. You know, but do you, even though it was a free trade, 4 days to get 297 pips, no one's going to sneeze at that. Even if it was at half a unit or a quarter of a unit that was trailing, it still averages up pretty well. You know, now, when you say your average ended up at 78, is that 78 pips per day? Yes, it is 78 pips per day. And if you look at the percentage of what was left trailing, that'll decrease that 78 pips. For example, if you were trailing half a unit or 50%, then you're 78 pips total. Oh, okay. So, 297 pips to get 78 pips. So would it have been better than Brent to close, most out at 50 and close the remainder out at 100? And not have the angst of the next 4 days? I don't know. That's something we have to discuss. Everyone has to have a look inside themselves and figure out. Sounds good though when you say you had a trade running for 4 days at 297 pips. Aid once mentioned that he had a trade going a long-term swing trade and had a wonderful net return, but he struggled with the anxiety and angst every night about whether or not his position would turn against him. And what ended up happening is it hit his target, which was fantastic, but his net result per day was like 32 pips. So Aid turned around and started thinking, well, why should I go through a week or 2 weeks of emotional torment for 32 pips a day when I can scalp it, make 32 pips, go to bed, not have any open trades, and now I'm relaxed and and comfortable and not waking up at 3 or 4 o'clock in the morning and rushing back to your terminal to see what's happened in the market during the US session. So they're things that we have to come to grips with the way I trade, with the way we trade. Some of us emotionally are just not set up for it. I know personally, I do tend to feel more comfortable scalping because I'm in and out of a trade. Even with the swing failures, sometimes they can run for 3 or 4 hours. I still get a little bit antsy if I don't see it moving straight to my position. And I'm learning, like all of us. It's going to take a while for me to get under it, and this is why my trading plan is so important for me. But at the same time, guys, that day when I sat there and traded for 24 hours and made 1,000 odd pips in 227 trades, I'm not ever going to do that again. I did it for my own, to say that I've done it, but it didn't prove anything. It took me 3 days to recover, when I could have just spent those days trading and made the same amount of money in 3 swing failures as I did with 227 scalps. So you've got to look at the amount of effort and energy expenditure and everything else. Still a great trade though, Brett. Pretty impressed, buddy. That's really good. Especially the patience to sit in there for 4 days. Does anyone have anything they'd like to say or anything they'd like to discuss or any trades they'd like to post? Or better yet, does the concept of this scaling in or out actually make sense? Because if we're all pretty happy, guys, I will actually stop recording. So